Hi folks, good morning. Dr. Miller welcoming you to our Upper Iowa University Week 7 mini lecture of our BA341 Corporate Financial Management course. In Week 7, we look at capital structure and raising capital includes the cost of capital consideration. We review chapters 14, 15, and 16. Want to add to remind you that we have two participation items this week. Discussion question 1 and discussion question 2, as well as a short answer assignment. As we think about this concept of capital structure, we begin with a cost of capital discussion. Here we look at some of the key concepts include a firm's cost of equity capital, how to determine a firm's cost of debt, some things to consider. We want to know that the return earned on assets depends on the riskiness of those assets. We want to understand why the cost of capital is important. Understand that the return to an investor is the same as the cost to the company. Our cost of capital, be it 5% or 10%, provides us with an indication of how the market views the riskiness of our assets. Knowing our cost of capital can also help us determine our required return for capital budgeting projects. Required return. The required return is the same as the appropriate discount rate and is based on the riskiness of the cash flows. We need to know the required return for an investment before we can compute the net present value and make a decision about whether or not to take the investment. Remember that we need to earn at least the required return to compensate our investors for the financing they provided. With respect to the cost of equity is the return required by equity investors given the risk of the cash flows from the firm. There are two major methods for determining the cost of equity, using the security market line approach or capital asset pricing model and or the dividend growth model approach. Okay, the cost of debt. This is another one, final point. The cost of debt is the required return on a company's debt or bonds. We usually focus on the cost of long-term debt or bonds. Bear in mind that the required return is best estimated by computing the yield to maturity on the existing debt. We may also use estimates of current rates based on the bond rating we expect when we issue new debt. The cost of debt is not the coupon rate. Finally, the weighted average cost of capital. We can use the individual cost of capital that we've computed to get our average cost of borrowed capital for the firm. The average is the required return on the firm's assets based on the market's perception of the riskiness of those assets. The weights are determined by how much of each type of financing is used. All right, folks, enjoy this week. Just want to introduce the basic concept of the cost of capital. See you in the discussion forums. Thanks.